It's great to hear a little bit of laughter. You've written your first test. Hopefully it went well. It was on chapter 1 and 2, study unit 1 and 2. But it's time to move on just before your first recess of semester 2. So I need to carry on with break-even analysis. We're right on schedule, and it's great to see all of you here. The first part of this break-even analysis is easy, but I think the second part needs a little bit of attention. The algebraic section of break-even analysis. So this video is going to help you, as you'll be able to see the video over and over. I haven't seen you for a week, so I just want to refresh. Break-even analysis is represented either by a graph or by an algebraic expression, and in this graph, or on this graph, or this algebraic expression, we look at the relationship between the production quantity or volume, costs, revenue from sales, and we're going to analyze the profit of an enterprise when we're looking at the break-even analysis. So we're going to have a look at sales, costs, both fixed and variable costs, when the quantity or the volume produced differs. So the break-even point is where income is equal to expenses, and at that point no profit or loss is made. When we do this section, we assume in all these calculations that all the products that are produced are sold. So that's the assumption when we do break-even analysis. Break-even analysis provides crucial information with regard to the business. The following information can be provided. What is the effect on profit if the business increases or decreases the price? To what extent will profit increase when production increases and sales increases? What effect will an increase in the fixed cost of items being produced or running the business? What happens if there is a change in a fixed cost? For example, the rent of the building increases. What effect will that have on profit? What effect will a change in the variable cost have? So let's say, for example, the more items you produce, there might be a variable cost. For example, more wages need to be paid as you need more staff. What effect will that have on profit? Then what about, or what is the critical sales quantity? We will look as we go through in this video what is the critical sales quantity, what it is, what happens when it's reached. Okay, here it says it's the break-even quantity, so it's the minimum number of products to be sold by an organization in a given time period. And what sales quantity and production capacity must be maintained to achieve the planned profit. So break-even analysis tells us quite a bit about the business. So you can see the importance of being able to calculate the break-even point. It's time to look at an example. So example 1, Waltons manufactures and sells lever arch files. so they manufacture files, the following information is available to you. There's a selling price per file. The selling price is 60 Rand per unit. That is P, the price. The total fixed cost, it doesn't matter how many lever arch files are produced, the total fixed cost, TFC, is 400,000, and the variable cost per file, VC, is equal to 20 Rand. So let's just recap there. The unit price of a lever arch file is 60 Rand. It doesn't matter how many files are produced, the total fixed cost is 400,000, and the variable cost per file is 20 Rand. The number of lever arch files manufactured and sold may vary between 0 and 18,000. And when you draw this up on a graph, you can draw it up in multiples of 2,000. Q will represent the number of lever arch files, quantity. FC is fixed cost. TVC is total variable cost. And TC is the total cost, which will be fixed cost plus total variable cost. Total variable cost, you will see, will be quantity multiplied by variable cost. From the previous information that we were provided, we were asked to construct a break-even analysis table, and it looks like this. So we got price of a lever file, quantity produced, fixed cost, the variable cost per unit, total variable cost, as I mentioned before, is variable cost multiplied by quantity, variable cost multiplied by quantity. Total cost is equal to the fixed cost plus the total variable cost. And sales income is equal to price multiplied by quantity, and the profit is equal to the price multiplied by the quantity, which is the income, right? So profit is equal to the price of each file multiplied by the quantity sold less total costs. And remember, total cost is fixed cost plus variable cost. So when you're doing a table like this, it's important to understand the table and how each, let's say, variable or each column is derived. So I'm going to run through that again. We have price. Each file, the unit price was 60 Rand. Q is for quantity, and they said they must do it in multiples of 2,000. So in this first row, no files were produced, but the fixed cost is still 400,000. The variable cost is 20 Rand per file. The total variable cost, important, total variable cost is the variable cost, 20 Rand, multiplied by the quantity. And if I take the first row where no files were produced or sold, the total variable cost is 0 because no files were produced or sold. Now, if no files were produced or sold, there's still a fixed cost of 400,000. there was no total variable cost, so the total cost is 400,000. There were no sales, so the income is 0, and in this case here, income less expenses, the total cost, there was a negative value of 400,000. As we move down this table, this break-even analysis table, you will see when we get to a quantity of 10,000, the fixed cost is 400,000, the variable cost per unit is 20 Rand, the total variable cost is the variable cost multiplied by the quantity, and that is equal to 200,000. The total cost is 400,000 plus the 200,000. So it's fixed cost, total cost is fixed cost plus total variable cost. You're going to have to pay careful attention. If you watch this video again, I suggest you put your earphones on and you'll be able to focus and concentrate really well. So total cost is 600,000, and here we have the income, which is the price per file multiplied by the quantity, the price per file multiplied by the quantity sold, 60 times by 10,000 is equal to 600,000. So let me say that again. At the sale of 10,000 units at a unit price, selling price of 60 Rand, fixed cost of 400,000, a variable cost per unit of 20 Rand, total variable cost of 200,000. That means the total cost, which is fixed cost plus total variable cost, is 600,000, and an income of 600,000. 600,000 is equal to 600,000. So income is equal to total costs, and therefore that is the break-even point. Now when 18,000 units are sold, which is all the files are sold, a profit of 320,000 Rand is achieved. There you can see the income less the expense, the total costs, and at that point 320,000 Rand profit has been achieved. That's obviously where you want to be. You want to sell as many or all the products in order to maximize profit. You could analyze these fixed costs and variable costs and see if you could make a difference there, because that could increase your profit. But the way things stand at the moment, if all 18,000 files are sold, there will be a profit of 320,000, all things being equal. If we represent this data on a graph or a chart, this is what it will look like. So we have total sales income, and on the y-axis there we're looking at a total amount of income earned, 200,000, 400,000, 600,000, 800,000. On the x-axis you got quantity, so you've got price and quantity. You remember that from straight line graphs, and the quantity is in thousands, so you got 2,000, 4,000, 6,000. It goes up in 2000s from 0 all the way up to 18,000, which is the number of files that were produced. Now, if 0 files were produced, there's still a fixed cost of 400,000. There's a variable cost on top of the fixed cost. The total variable cost was 20 Rand per unit. And if you add your total fixed cost plus your total variable costs, that's why this graph here has shifted, because your total cost consists of total fixed cost and total variable cost, and that gives you total cost. This here is your sales straight line representation. It's the income. Over here, at this particular point, there is still a loss. At this point here, there's a break even where the costs equal the income, and above that there will be a profit. So if we look at the numbers involved, the break even point, as we've seen before, that should actually just be 10. It's when 10,000 files are sold, and the break even point there, income wise, needs to be 600,000. So this here represents what we have been doing graphically. So there's an example that's nice to see of a break-even analysis once it has been put on a graph. So in the previous slide, we looked at a graph of break-even analysis representing break-even analysis, but instead of using a graph, the break-even quantity or the profit or loss projected for different sales quantities can be calculated algebraically, right, using a formula. Now, in order to do this, to calculate variables using algebra for break-even analysis, we need the following variables for an algebraic calculation. We need Q. Remember now, Q is the number of units manufactured and sold. So produced and sold quantity. The total fixed cost, TFC represents total fixed cost. The variable cost, VC, is the variable cost per unit. It's good to familiarize yourselves with these abbreviations. P is the selling price per unit. QB, now remember Q is quantity, and that little b stands for break-even quantity. So QB is the break-even quantity if we need to determine the break-even quantity. The total variable cost is variable cost multiplied by quantity. We have seen some of these abbreviations before, but it's good just for a refresher. And total cost is total variable cost plus total fixed cost. So there's something new, a new abbreviation. At what quantity, or what quantity produced or sold, is the break-even point, represents the break-even point. Remember, in all these calculations, we made the assumption that all units that we're looking at will be sold. So we are now going on to break-even analysis, and we're going to use formulas or algebraic expressions in order to calculate, say for example, the quantity where the business breaks even. So we've just seen what Q, TFC, variable cost P, QB, TVC, and TC stand for. Just their total cost is made up of total variable cost plus total fixed cost. Total variable cost is variable cost times by quantity. So let's move on. Selling price per unit less the variable cost per unit is something called the contribution per unit. So in the example, or from the table on the files, what we've been working with, there was a selling price per unit of 60 and less the variable cost per unit gives us 40 Rand, which is the contribution per unit. So the selling price per unit less the variable cost per unit is equal to the contribution per unit. So sales minus, let's say, cost price is equal to, let's call it the gross profit per unit. But yeah, we're talking business language and not accounting language. So 60 Rand was the price, 20 Rand was the variable cost per unit, so 40 Rand is the contribution per unit. Now, total sales, so if we multiply the 60 by the total quantity, less the total variable cost, so if we multiply 20 by the total quantity, gives us the total contribution. So in this first line, let me rub this out. At the top here, they were talking about the contribution per unit. Their contribution per unit. They also talk about the total contribution. So that is the total, you multiply by the quantity, and also the total variable cost multiplied by the quantity. That will give you the total contribution. So profit is equal to total sales income less total costs. So price times by quantity, so the 60 Rand multiplied by whatever quantity it was, less the total costs. Now remember, total costs is total variable cost plus total fixed cost. You're going to have to watch this a few times. Profit is equal to total sales income minus total costs. So profit, that in other words, profit is equal to price times by quantity less total costs. Now what made up total costs? Total costs was made up by total variable cost and total fixed cost. Gonna rub this out. So total cost is made up of total variable cost and total fixed cost. What they're doing is they're just breaking down total costs, which consist of total variable cost and total fixed costs. There it is over there. And this here, P multiplied by Q, that's why you need to know your abbreviations. it's price multiplied by quantity, which is the total sales income. Now they break it down even further. We can say PQ, income, minus variable costs times by quantity, and a minus multiplied by a plus becomes minus total fixed costs. So total variable costs, let me clean this up. Total variable cost was broken down. Total variable cost is made up of variable cost multiplied by quantity, and that minus multiplied by a plus becomes minus total fixed costs. So income let's call it total variable cost, which is made up of variable cost multiplied by quantity minus TFC. Now if you take out Q as a common factor, you end up with profit is equal to quantity multiplied by price minus variable costs minus total fixed costs. So they're playing around with this formula. They're breaking it down. At break-even quantity, profit is 0. To determine the break-even quantity, QB, set the above equation to naught, equal to naught. So now you have this equation equal to naught. There it is, equal to naught. They've just put in a little b for, they're calling it the break-even quantity. And if you solve for QB, that is the quantity where the business breaks even, the number of products produced or sold, the formula is equal to fixed cost over P, price, minus variable cost. So that formula was derived. Might be easy just to remember that. The break-even quantity is equal to total fixed costs divided by price minus variable cost. Break-even units is equal to fixed cost divided by contribution per unit, because P minus VC, P minus VC is equal to contribution per unit. What I suggest you just remember, that's how that was derived, that formula. For a business to break even, the question is how many units need to be sold or produced, and that is the formula. Break-even units is equal to fixed cost divided by contribution per unit, and that's our contribution per unit there in this example, per unit. That's how it was calculated. But if you remember that formula, you're going to be able to calculate the number of units that need to be produced or sold in order to break even. Now what we've done, what we just did, is we derived this break even, how many units need to be produced or sold in order to break even, how many units. So the formula which we just derived is fixed cost divided by contribution per unit. Now if we look at our table with the lever arch files, there's the fixed cost, 400,000, there it is. the break-even units that we need to sell is fixed cost divided by contribution per unit, and the contribution per unit is 60 Rand P 60 minus the 20, which is the variable cost per unit, the contribution per unit. So we're looking at an individual file, selling price 60 Rand less the variable cost per unit of 20 Rand. So we substitute in the numbers from the table. We've got the fixed cost and we've got the contribution per unit, which is price minus the variable cost per unit. And if you punch that into your calculator, where this business breaks even, there you've got 10,000 units need to be produced and sold. Let me just clean this up and we move on a bit. So there we calculated the break-even units. Now to calculate the break-even sales in Rand value, the selling price is multiplied by the break-even quantity. Now the selling price in our example was 60 Rand. To calculate the break-even sales, the selling price is multiplied by the break-even quantity. There's the break-even quantity, we just calculated that, 10,000. So 10,000 multiplied by 60 is equal to 600,000. Now what they have done here is they've used break-even sales formula, which is fixed cost divided by contribution per unit multiplied by the price, which is 60. The fixed cost from our example is 400,000 over the contribution per unit, which was 60 Rand, the selling price, less 20 Rand, the variable cost, multiplied by 60 Rand, which is the selling price, and that is equal to 600,000. So that is the break-even sales amount. It's quite simply the quantity multiplied by the price, which was 60 Rand. But there's a formula: break-even sales, fixed cost divided by contribution per unit. This contribution per unit can catch you out. They're looking at one file. In this case, remember, we're using the Waltons files, and it's selling price minus variable cost, which will give you the contribution per unit. That's how we calculate the contribution per unit. The margin of safety, the units which measure the margin of safety, is calculated by taking the total amount of units and subtracting the number of units at the break-even point. That is how you calculate the margin of safety in units. So in our example, the margin of safety would be 18,000, total number of units produced and sold, less the number of units at the break-even point. So the margin of safety is 8,000 units. Now if you wanted that in a Rand value, to calculate the margin of safety in Rands, we just take the number of units multiplied by the price of each file. So the margin of safety in rands is 480,000. So there's how to calculate the margin of safety. Then there's one last calculation we need to do in order to calculate the contribution ratio. What we need to do, here's the formula. The contribution ratio is equal to total contribution in rands divided by sales in rands. Now remember previously we looked at what makes up total contribution, and total contribution in rands is the sales income less the total variable cost of 360,000 divided by the sales in rands. So let's have a look. Let me go through that again. The total contribution in rands is the 1,080,000 less the 360,000 divided by the 1,080,000. Let me clean this up. And if you want a ratio or a percentage, you need to multiply by 100. So let's do that quickly again. The total contribution in rands divided by sales in rands. So it was total income from sales, 1,080,000 less the total variable cost, and it's divided by the total income, sales in rands, multiplied by 100 to get a percent, and there's the percent rounded off to 2 decimals, 66.67%, and that's how you calculate the contribution ratio. This has been quite a tough little section, but after a bit of practice and once you've watched the videos a few times, I have no doubt that you will be able to apply the formulas, and you will know where to get and what to get, which numbers to get to put into the formulas. So a little bit of practice and you will be a master at doing certain calculations with regard to break-even analysis. See you soon. Cheers.